All right. Hey, everyone. Thanks for joining me today as we explore the trader's path, mastering bias, psychology, and risk. So this session is all about building the foundation for consistent and confident trading by mastering these three critical pillars: market bias, trading psychology, and risk management. Trading isn't just about having the perfect strategy or tools, right? It's about how you apply them under pressure. In my 14 years of trading, well, to be fair, not all of that's trading, but some of it's investing. Nevertheless, I've learned that most traders fail because they don't fully understand or control their bias, emotional reactions, or risk management. I've personally missed trades due to unclear bias, made emotional decisions in drawdowns, or taken outsized risks, breaking my plan, or sometimes not even having a plan in the first place. These lessons taught me that trading success comes from discipline and execution, not just skill or analysis. So today we're going to talk about strategies to help overcome common trading challenges so you can trade with clarity, confidence, and consistency. So this is what it looks like. Quick little intro is going to take a couple minutes. We're going to talk about market bias for about 15 minutes, trading psychology and risk for 15 minutes, then a quick conclusion and any questions at the end, or in between, wherever you think is appropriate if you don't have understanding. So by the end of this session, the idea is to walk away with you're able to determine and leverage market bias effectively, maintain emotional control even in high pressure situations, and manage risk in a way that protects your capital and supports growth. So let's take a moment to reflect. What's one trade where you knew what you should have done, but you did the opposite? Did you hold onto a losing position too long, close out too early, or hesitate to take the trade at all? Keep that trade in mind as we go through this session. My goal is to help you develop the tools and mindset to act decisively and align with your plan next time. So let's dive into the first pillar, market bias. Market bias is the foundation of every trading decision. It's the directional edge or framework we use to decide whether we're focusing on long, short, or neutral trades in the market. Why is bias so important? Because without it, we're flying blind. If you're trying to trade without understanding the bigger picture, you'll find yourself second-guessing your entries and exits, or worse, trading against the trend. We'll break bias down into 4 actionable categories: higher time frame analysis, technical tools, seasonality and historical patterns, and sentiment analysis. First is how to use higher time frame analysis effectively in your trading. So this is the first and arguably the most critical step in building a strong market bias. Higher time frame analysis is like zooming out on a map before planning your route. You're looking at the big picture to identify the dominant trend, key support and resistance levels, and overall market sentiment. So why are higher timeframes essential? The higher time frame gives us the context we need to avoid trading against the larger trend. It filters out noise and helps us stay aligned with the market's overall direction. Think of it this way. If the 4-hour chart shows a clear downtrend, but you're looking for long setups on the 15-minute chart, you're swimming against the current. You have to work so much harder. So we'll show an example in a second, but this is how multi-time frame trading works, right? We combine a higher time frame to determine the directional bias with a lower time frame to find entry and exit opportunities. The higher time frame sets the narrative. Are we bullish, bearish, or neutral? The lower time frame helps us time our trades with precision. For example, the 4-hour chart shows a bearish trend with a series of lower highs and lower lows. We'll focus on short setups. On the 15-minute or 30-minute chart, we'd look for pullbacks into resistance levels for short entries that align with the higher time frame. Before we look at an example, one common pitfall and question I always get is starting your analysis on the lower time frame and then working your way up. This is called the bottoms-up approach. It works very well in business, but it doesn't work in trading because it leads to confirmation bias. For instance, if you see a long setup on the 15-minute chart and convince yourself the higher time frame supports it, it doesn't work because you're convincing yourself it does. The market should be showing you. You have to read it like a book. Instead, always start with the top-down approach. Begin with the higher time frame to define the market structure and identify key levels. Then move to the lower time frame to refine your trade setups. So here's a simple example. Higher time frame is the 4-hour on the left chart. We have a clear downtrend. We can see LH, lower highs, and LL, lower lows. Prices approaching down a resistance level that's been respected in the past. This tells us the market bias is bearish, and we should focus on short setups. So then we look on the right, we see the minute 30 chart. We see a pullback. Maybe there's a limit order here in the first time. And then the second time, we actually have a nice entry. This could be a bearish setup to then take a short to our previous level. It seems easy, but it's simply because we have a higher time frame picture. We're not trying to swim against the current. We can see on this next image, this is the 15-minute chart. This is all in Euro USD. Yes, down here could be a good counter trend setup. You can say, hey, there's a great trigger. I decide to take this long and I get to the level and it works. But look how long this takes. This is, a couple dozen 15-minute candles. If you instead traded with the trend, it accelerates your trade. This isn't to say counter trend trading can't work, but it's much easier to always swim with the bias, with the bigger picture in order to make smart trading decisions. So the key takeaways that you should have when you look at higher time frame analysis is always start with the higher time frames to define your bias. Are we bullish, bearish, or neutral? Use the lower time frame to fine-tune entries and exits that align with the higher time frame. And the most important bit is you need to collect a plan. You need to collect data, even if you're forward testing or trading paper or trading small money in the market. So you need to stick to the same system for at least 30 to 50 trades to build consistency and avoid unnecessary noise. Before we move on to technical tools, are there any questions about higher time frame analysis? Cool. All right, so next is technical tools. So there's different types. There's moving averages, 200 SMA, simple moving averages, EMAs, exponential moving averages, VWAPs, volume weighted average price, market structure, trendline analysis, Donchian channel. There's countless technical tools that people use. You may have heard the RSI, stochastic oscillator. There's so many different types, but let's dive into what they look like, and we'll just show a few today. So this is an example of the 200 simple moving average. So this is a classical tool for identifying long-term trends. If price is above the 200 SMA on the higher time frame, the bias is typically bullish, and we focus on long setups. Below the 200 SMA, our bias is bearish, and we look for shorts. So in this example, we can see that the price is below on the 4 hour, so therefore we should be looking for longs, for shorts. But what's also very interesting to note is when price pulls back to some of these levels. Again, this is just a simple moving average, so it just cares about price. We'll look at VWAP in a moment that also cares about volume, but we can still see that here, the price pulls back near the 200 simple moving average and then has a big dump. Now, I'm not saying you should enter off of any one individual aspect, but it might be interesting to look at a lower time frame chart like the 15 or 30 minute based off the 4 hour to see maybe there's a trading opportunity here. Talking about price and volume though, we can look at the anchored volume weighted average price, the anchored VWAP. The anchored VWAP is a dynamic level of support and resistance that adjusts with price and volume. By anchoring VWAP to a key point, like the start of a week or a month, we can find reliable zones for pullbacks or breakout. So here on the 4 hour chart, we could anchor the VWAP to the beginning of the month, which is what we have. It's going to reset every month. And notice when price repeatedly respects it as resistance. This reinforces our bearish bias. So if we see here in the center of our chart, we can see that it retests. We had the SMA that was up here, and maybe you take a short there, but it also breaks below the monthly VWAP, retests it, and continues to dump, right? And so these are moments where we can refine our entries, but overall we're looking at a technical tool that objectively categorizes the market as bullish or bearish. Another tool we can look at is market structure. Now, many people use market structure dynamically by looking at the market and making their own decisions. However, here is market structure on higher time frames, and this is just a little part of the market that I've marked out, which is one of those powerful tools for determining bias. Higher highs and higher lows indicate an uptrend, bullish bias. Lower highs and lower lows indicate a downtrend, bearish bias. Consolidation means the market is neutral or waiting for a breakout. So, for instance, here we can see that we have a lower low, we have a higher low. The market overall, we can see, is having the higher floor, right? Our lows are increasing. And ultimately, we have a nice little push up. And so we can use market structure to overall have our bias go up. Or we can see that we have a lower high, we have a lower low, lower low. You could find an entry like we did here. This is that same example from earlier where we pull back into resistance with very obvious bearish market structure on the higher time frame, in this case the 4 hour, to then enter on a smaller chart like the 30 or 15 minute. Ultimately, higher time frames reveal the most important levels, whether that be from technical tools or, you use trend lines or, this sort of descending pattern. You look at the market in this particular way, but ultimately, higher timeframes are critical for planning entries on lower timeframes. You need to see the bigger picture. This is a simple example of trend lines, but I hope it's clear enough considering the earlier example from pulling back into that resistance level. But we can still see here on the 4-hour, breaks this level, clear dump. Breaks this level, clear dump. But if it breaks the top level, does it necessarily guarantee a good trade? No, it doesn't. Here's a good push long, but ultimately, is this really a good push on the 4-hour? Not really. It's much smaller compared to the very obvious dumps we see here from the 4-hour. So you need some other levels of confluence. You can't just use any one of these tools in isolation. But before we wrap up, combining these tools, simple moving averages, VWAPs, market structure, key levels, and many other types that I didn't mention, we create a framework that allows us to trade with confidence. The higher time frame gives us the clear bias, and the lower time frame refines our entries and exits. So that's higher time frame analysis and technical tools, ways to view it. Any questions about any of those two things so far, or is it all clear? Cool. All right. So let's talk about seasonality and historical patterns. So seasonality is a powerful force in the market. It refers to recurring patterns or trends that happen at a specific time of the year. These patterns exist across many asset classes, including stocks, commodities, currencies. For example, we often see the Santa Claus rally during the last week of December, where the market tends to perform strongly due to year-end buying and optimism. By understanding these trends, traders can align their strategies to improve profitability and make more informed decisions. But it isn't just about recognizing patterns, seasonality. It's about incorporating them into your trading plan. Another couple examples are sell in May and go away is a popular one, where data shows weaker market performance during summer months. A trader could reduce exposure in May and return in November when the market activity tends to pick up. There's also sector-based patterns, like energy stocks often rally during winter due to increased demand for heating, oil, and gas. Retail stocks perform well in Q4 for holiday shopping. And agricultural commodities like wheat and corn tend to rally in spring as planting begins. Here's a simple example where we can see a seasonal trend on oil. Again, winter in the northern hemisphere. Obviously, it's the opposite in southern, but most people live in the northern hemisphere. In northern hemisphere, for December to early March. And we can see that here's your overall low, and that keeps on rallying all the way until the end of February. Now, you can look at this two ways. You can say, hey, I can try to find a nice long position. My bias can be overall long, but this is just one tool. But ultimately, you can also look at to find a counter trade, and you can say, cool, near the end of February, there might be a good short. And so maybe you can find a position that way. Another example is June to August. Gold tends to rally, the summer trend. And of course, it's not as strong as that oil example, but overall, you can see here in June, there's somewhat lows, and overall, it tends to grow. So this can be part of your comprehensive trading system to understand the bigger picture in the market. Ultimately, implementing seasonality-based strategy involves not only identifying patterns, like known seasonal trends using tools like the seasonal charts we just looked at, or historical performance data. For instance, a very common one is the various levels of volume that exist on a daily week from Monday to Friday, right? How Monday may have more volume and Friday may have less. But ultimately, these are all historical patterns. What you really need is you need to align with other forms of analysis like technical analysis, or support resistance or trend lines. For example, if seasonality indicates a rally, but price is below a critical resistance, you have to wait for confirmation before entering, right? But ultimately, you need a backtest, to see how it would have performed on historical data. And ultimately, seasonality isn't foolproof. You need to use proper position sizing and stop loss strategies to protect your capital. It's important to remember that while seasonality can give you an edge, it's not a guarantee. Market conditions can change, and unexpected events like economic shocks or geopolitical crises can disrupt even the most reliable patterns. For example, the sell in May strategy might not work during a year of strong economic growth or stimulus-driven rallies. Think about the pandemic. That's why combining seasonality with technicals and fundamental analysis is key to improving your edge. So that's seasonality. We're going to talk about sentiment analysis. Any question about seasonality? Cool. All right, so sentiment analysis is all about understanding the psychology of the market. It helps us gauge whether traders and investors are feeling bullish, bearish, or somewhere in between. So why is this important? Market sentiment often drives price action in ways that technicals alone can't explain. For instance, when fear dominates the market, you'll often see investors rushing to sell, even if the fundamentals don't support it. On the other hand, excessive greed can push prices to unsustainable levels. We use sentiment indicators to measure this collective emotion, which can help us predict potential reversals or confirm existing trends. For example, if sentiment is extremely bearish, it might be a contrarian signal that the market is oversold and due for a rebound. There are several sentiment indicators traders use to gauge market psychology. Here's a few of the most popular. The VIX, or the volatility index, this measures market fear or greed. When the VIX spikes, it's often a sign of panic selling. Contrarian traders might look for buying opportunities, or you could try to go with the trend and find a good selling one. Here's an example of that. The VIX is spiking on the left, and we can see, it's not immediate. It's not an immediate time-based indicator, but the VIX is spiking, more fear, more selling. And we look here on the right, where we have the US dollar index selling, and you're just selling fear. And therefore, obviously, fantastic little short. You need more analysis than just this to take any trade, but it's a simple example where the VIX is spiking, and as a result, the market is dumping because people are selling because they're fearful. There's another example, or not another example, a different way of looking at market sentiment is the put-call ratio. So this tracks the ratio of put option buying to call option buying. A high put-call ratio indicates bearish sentiment. If it becomes extreme, it may signal a market bottom. So here on the left, we have the put-call ratio for equities plus index on the CBOE. And right, we have the daily chart for the CBOE where you could actually take trades. And we can see here, if you line up our little crosshairs, how, it kind of has this double bottom and ultimately, rallies up. And we can see that the price of the CBOE also rallies up as well. There's other ways of looking at sentiment. For instance, the Commitment of Traders report, which shows how different trader groups are positioned in the futures market. For instance, if speculative positions on oil are extremely high, it may signal the market is overbought. There's also stuff like odd lot trading statistics. This measures smalls trades, usually by retail investors. When odd lot buying surges during market extremes, it can signal the end of a bullish run. These tools ultimately give us a window into how the broader market is thinking and feeling, helping us align or even go against the crowd. So how can we actually use sentiment analysis in our trading? So let's break it down. Confirming trends. Sentiment indicators can validate a trend. For example, if the put-call ratio is rising alongside falling prices, it's a confirmation of bearish sentiment and trend. You also can use it as a contrarian signal. When sentiment extremes occur, such an extreme greed or an extreme fear, they can often signal a reversal. For instance, when the VIX spikes to very high levels, it can indicate a market bottom is near. Or you can combine it with technicals. Sentiment analysis works best when paired with technical analysis. For example, if sentiment shows extreme fear and price is testing a major support level, that alignment creates a strong case for a long trade. While sentiment analysis is powerful, it's also important to understand its limitations. It's not a timing signal. Just because an indicator shows extreme sentiment doesn't mean the market will reverse immediately. These extremes can persist for days, weeks, or even months. That's why sentiment is best used alongside technical or fundamental analysis. Also, context matters. Sentiment doesn't account for external events like earnings reports, interest rate decisions, or geopolitical news. Always consider the even bigger picture. And don't over-rely on sentiment either. Think of its sentiment as a supporting tool. It provides valuable context, but shouldn't be the sole reason for entering or exiting a trade. Sentiment analysis gives us a unique perspective into market psychology, helping us understand how emotions like fear and greed drive market behavior. Combined with higher timeframe analysis and seasonality, it's a powerful tool for building market bias. Next, we're going to talk about trading psychology and risk, where we'll explore how to control our own emotions and mindset during trading. But before we do so, any questions at this point about anything about market bias? Cool. All right. So, trading psychology and risk management go hand in hand. Strong psychology helps you execute your strategy without succumbing to fear or greed, while solid risk management ensures that even when you're wrong, you can survive and continue trading. But here's the reality. Most traders don't make it. According to FINRA, 72% of traders end the year in losses, and a shocking 90% of new traders blow up their accounts within the first 90 days. Only 1% of traders are consistently profitable after 5 years. These statistics highlight one thing. Without discipline, a strong mindset, and clear risk management plan, your chances of success are slim. So let's talk about the most common psychology pitfalls. FOMO, fear of missing out, leads traders to enter setups late or take trades that don't meet their criteria. Revenge trading. After a loss, it's tempting to try and make the money back quickly, but this often leads to impulsive and emotional trades. Hesitation. Fear of losing can paralyze you even when you see a clear setup. And overconfidence. After a winning streak, some traders increase their position sizes recklessly, which can lead to massive losses when the market turns. So, managing emotions while trading requires preparation and actionable tools. Let's explore a few that can help you stay disciplined and focused. First, let's talk about journaling. This doesn't have to be fancy. Tools like Google Sheets, Excel, or even a simple notebook are more than enough. Log why you took the trade, what you were thinking, and how it turned out. Over time, you'll identify patterns. Do you hesitate after losses? Do you overtrade after wins? Journaling makes those habits visible so you can address them. For example, if you notice most of your losses happen when you trade outside your plan, you'll have hard evidence to help stop that behavior. So here's a few examples of journals. This is not mine. This is an image I found on the internet. But we can see that we see simply the date, the asset that you're trading, the time it was traded, when did you enter, when did you exit, why did you enter, what happened during the trade, what happened when you exited, and what happened even after you exited, right? It's a simple journal. It's more words than data. But ultimately, this works as long as you can track why you take trades. Another example is this. This is a lot more data. This is my journal. I like data. But ultimately, it doesn't matter how many columns you have or how much data you secure. You could simply write a few paragraphs on a piece of paper. Why did you enter? What's your goal? When did you exit? Ultimately, a journal is a tool. It doesn't have to be fancy. It's just about tracking the decisions that you're making. But journaling is about after you've made that decision. What can you do to help ensure that you have that mental clarity before you make the decisions? Visualize success before you start trading. Trading is a high-performance game. Think about professional athletes. They don't just walk into a game. They prepare mentally and physically. So why wouldn't you do the same as a trader? Create a pre-trade routine that gets you in the zone. Play music, meditate, or visualize executing your trades flawlessly. Focus on the process of following your plan, because that's one of the most important mindset shifts in order to master your own trading psychology. You have to focus on the process, not the outcome. If you have a clear plan, with at least 100 trades backtested, showing positive expectancy over time, your job isn't to chase wins or avoid losses. Your job is to simply execute that plan. Some trades will win, and some will lose. That's normal. The goal is consistency. If you follow the process, the profits will take care of themselves over time. For example, let's say your backtested strategy has a 55% win rate with a 1-to-2 risk-reward ratio. That's proven to be profitable over time. As long as you stick to the plan, the statistics will work in your favor. But the moment you deviate, you introduce randomness, and that's when emotions can take over. Because ultimately, that's the foundation of emotional control. You need a clear plan. Without a plan, emotional or psychological tools are irrelevant because you're not trading. You're gambling. Your plan doesn't have to be overly complicated, but it must include a defined edge, why you take trades, rules for entries and exits, and a clear risk management strategy. If you don't have a plan with a history of success that's proven, black and white, it's impossible to trade with confidence or emotional stability. Your emotions will run wild because you don't have anything to anchor your decisions on. So remember, trading is about preparation, discipline, and execution. If you use tools like journaling, pre-trade routines to build consistency, but above all, you need to have a clear plan backed by data. With that foundation, you can approach the market with confidence and emotional control, knowing that your job is simply to follow the process. So, risk management is so important. Risk management is the key, one of the 3 keys, of your trading plan. So let's talk about risk-reward ratios. Every trade you take should have at least a 1-to-2 risk-reward ratio. This means for every dollar you risk, you're aiming to make $2. So why is this important? Because even with a 50% win rate, you're profitable over time. Think about it. If you risk $100 per trade, You only need to win half your trades to consistently grow your account. 2R means every time you win the trade, you earn $200, and every time you lose $100. So if you win one trade, you're up $200, and you lose one trade, minus $100, you still made a $100 profit over 2 trades. So let's determine how much risk you can risk on each trade. What's position sizing? So there's 2 ways. There's static sizing, which is the simplest method. You just risk the same dollar amount for every trade, regardless of a stop loss distance or volatility. For example, you might risk $50 on every trade. It's very easy to prefer this method because it's easy to calculate and apply. But there's also dynamic sizing, which can adjust your position size based on factors like the stop loss distance or even market volatility. For instance, if your stop loss on a trade is 10 pips, you'd size your position to ensure that a 10 pip loss equals your set dollar risk, say $50. But now if the stop loss is doubled as far, say 20 pips, your position size would be smaller to maintain the same dollar risk. And so this dynamic sizing method ensures that you have consistent risk per trade regardless of the setup. Another way of managing your psychology and your risk is having daily loss limit, which is critical for protecting your account and your mental state. For example, if your loss limit is 2 to 3% of your account, you stop trading for the day once you reach that point. So why is it important? Because emotional decisions often follow significant losses, and that's when traders tend to overtrade or take unnecessary risks. Now let's touch on a couple of advanced concepts just to introduce them. We're not going to talk about them too deep. There's hedging, which involves opening offsetting positions to reduce your exposure. For example, let's say you're long on a stock and worried about short-term pullbacks. You might buy a put option to protect against downside risk. This way, any loss on your stock position is partially offset by the gain in your options position. Typically, most directional traders or, beginners, intermediates won't even use hedging, but understanding it can be helpful as you grow as a trader. There's also delta neutral strategies, which involves balancing your portfolio that market moves in either direction have minimal impact on your overall position. For example, an options trader might combine calls and puts in a way that the portfolio's net delta, sensitivity to price movements, is near zero. So while this concept is more advanced, it's worth knowing because it highlights a key principle. Successful traders often focus on minimizing risk before maximizing profits. For now, stick with risk management tools, simple ones. Use at least a 1 to 2 risk-reward ratio. Start with static position sizing to build discipline, then explore dynamic sizing as you gain experience and confidence, and ultimately set a daily loss limit and stick to it. No exceptions. As you grow, you can explore more advanced techniques like hedging or delta neutral strategies, but for now, focus on mastering the basics because that's what builds long-term success. So here's a simple graph that is a very common one. I love this graph that shows the win rate required based off your R. Obviously, it's very attractive to look at this and say, oh, well, I want to make 5R per trade, and because I only need a 20% win rate. But that's the trade-off. It's very easy to look at this or look on YouTube or see anywhere and say, oh, this person has an average of 10R. Maybe that's true, but it probably isn't because there's a secret truth that you need. You need a backed up win rate. It's very easy to make one very good trade, but it's not so easy to make consistently good trades. And so if you aim for, say, 2R, it's much easier to have a higher win rate. If you aim for 5R every trade, yes, you only need to win 20% of the time, but it takes, and it's that much harder to consistently find those setups. And so this is why you need clear data in order to back up your plan, and why it's also important to first start with just a simple 2R. Because 50% is all you need to be profitable. In fact, 40% is all you need to be profitable. In fact, anything above 33% of the time is all you need to be profitable if you have 2R. But at the end of the day, it's a complete balance where you need data to back up your trades. Ultimately, these are the statistics that you need to think about when you're thinking about putting a trading system together. Maybe you feel like it's too much work or it doesn't make sense. But ultimately, this is why psychology and risk management are critical. These are facts from financial authorities around the world. 90% of traders lose 90% of the funds in 90 days. 72% of traders' year ends in losses, and only 1% succeed after 5 years. Many traders make the mistake of increasing their position sizes after a winning streak, which often leads to devastating losses. If you want to beat these odds, you must master your emotions and protect your capital with a solid risk management plan. But before that, you need a solid plan in the first place to execute your trades. Consistency is about following the plan. So, to wrap up, follow your trading plan consistently. Your edge only works when you stick to it. Manage your risk with strict position sizing and daily loss limits. Control your emotions by journaling and maybe even practicing mindfulness. But focus on the process over profits. Resilience comes from doing the right things repeatedly, not by chasing big wins. It doesn't matter how much you can win. It matters how many times you can lose. Before we wrap up, let's reflect on what we've covered today. We set out with 3 key objectives: identifying and leveraging market bias, using proven techniques like higher time frame analysis, seasonality, and sentiment. These tools give you the framework to align your trades with the market's overall direction, maintaining emotional control and improving trading psychology. Through practical strategies like journaling, pre-trade preparation, and focusing on the process over outcomes. And mastering effective risk management practice. To protect your capital and ensure consistent growth, emphasizing the importance of position sizing, risk-reward ratios, and daily loss limits. Together, these 3 pillars, market bias, psychology, and risk management, are the foundation of long-term success in trading. Now think back to the question I asked in the beginning. What's one trade where you knew what you should have done, but you did the opposite? Did you hold the position too long, close out too early, hesitate to trade the trade at all? Whatever your answer, the tools and strategies we've discussed today are designed to help you avoid these mistakes in the future. Remember, trading isn't about perfection. It's about consistency. It doesn't matter how much you can win. It matters how many losses you can endure while staying disciplined and sticking to your plan. So I challenge you to focus on building a solid plan, executing it with discipline, and treating every trade as a step towards mastery. Your next step is simple. Use the techniques we discussed to refine your market bias. Build your trading plan, backtest it, and trust the process. And above all, manage your emotions and your risk. Thanks for your time and focus. Ultimately, trading is a journey of continuous learning and self-improvement, and I'm confident that with the right mindset and tools, you'll take it to the next level. So if there's any questions about anything, feel free to ask about what we discussed or any challenges you're facing in your trading journey. But that's all I got. No worries, Abu Dhabi. Appreciate it. All right, thanks, Khan.